Hello and welcome to another episode of Darwin Investors. Man, rough day on the market. It's kind of funny what's happening right now. It's like people are like in a race to see who can exit the market first. We've got this inflation read that's going to come out on Wednesday, and I expected the market to tank tomorrow, but it's like people couldn't wait. They had to tank it today, and because of that, I was able to exit out of my covered call positions that I bought or sold right before the end of business on Friday. And so I closed all those out today because you really never know what's going to happen tomorrow. It could be flat. It could even go up a little bit, but or it could be further down. Who knows? But I want to get out of this position. Part of the trick of these options is you want to make sure that you take your money when you get the chance. And then I also saw a really big opportunity in the market coming up a little bit later this week on Taiwan Semiconductors. With me, my assistant, she asked me, she says, are these good stocks to buy? And I'm like, well, I don't know. I'm not really a stock picker as much as I am a trader. I mean, the stocks in my portfolio, I just feel like I just need to have stocks that are really solid, that have, good price to earnings ratios relative to their sector, relative to the S&P 500, that have great cash flows, that their operating margins are nice, especially relative to their own sector, but just in general, and that their CEOs are fantastic, like they're fantastically run companies because they have great CEOs. I've got like Satya Nadella from Microsoft and Pinchari from over there in Google, and who else I got? Marvin Ellison, Jensen Huang, the smartest guy on earth, Lisa Su, Carol Toomey, Marvin Ellison, Jamie freaking Dimon. Like when that guy speaks, it moves the whole market for like 2 weeks, And so these are the kind of companies that I kind of put my faith in. And then once I just build a portfolio around that, then I just start trading options. And so it's sort of like you have like a house, and you pay like $1 million for a house, and you're like, well, how do I get money out of this house while I'm living in it? Well, you can rent out the rooms. And that's essentially what I do. I have this foundation of companies, and I sort of just rent out my stocks to other. And I try to do it in such a way that I'm never going to lose a single share. And the way I do that is not through witchcraft or like some sort of black magic, but rather there is a method to it using an options probability curve and standard deviations. And I'll show you how that's done a little bit later in this video. And then I do want to talk more about the opportunity that I see coming up later this week in Taiwan Semiconductors. Also, like as a trader, what I like to do, and I haven't seen an opportunity I like this much in quite a while, but like if you're like a surfer and you're out there and you're surfing and you're kind of swimming around on your board and you're looking for that wave to come in, well, that's what I feel like I see. I see this wave coming and I'm like really pumped. I'm like actually going to make a little bit of money this week. And so I'm very happy. So let's go ahead and get into this, and I'll show you about how to select a strike price for some of these covered call options. All right here we got a normal distribution curve for options. Right here in the bottom here, you can see these are standard deviations. Anything trading within one standard deviation of the strike price will give you a 68% chance to win. Anything trading in the second standard deviation would give you an extra 28%. So now you're up to 95%. Third deviation would get you up to 99%. And then this last one here allows for those black swan events. So those black swan events happened every now and again. Think Netflix or like Facebook or what have you. But by and large, they're not going to happen to you, but they can. They're not as rare as we would like them to be. Let's put it that way. Now, if you have some trading platforms like Thinkorswim by TD Ameritrade or Webull, this stuff's already calculated for you. They do it by way of delta. You just look at your delta. So if you have a delta of 68, that would mean that you're right at the border of one standard deviation away from the strike. And if you're buying a call with a 68 delta, that means you have a 68% chance of finish in the money. Now, where there's a buyer, there's a seller. So if you're buying this call, someone else has sold this call. So that person has a 32% chance to finish in the money. Now, with this graph in mind right here, before we get into really explaining this, let's go ahead and give some background. One, about Taiwan Semiconductors, which is going to be the equity that I'm going to be demonstrating the example for hitting covered call strike prices with, and selling puts as well. And we're also going to briefly preview the week that we have coming ahead. So let's start with that. So you can see here that tomorrow Pepsi reports and then Fastenal and Delta go on Wednesday. Also on Wednesday, the CPI data comes out. CPI, I think people are like really expecting a bad inflation read, as am I. But it's quite possible that we sold off today. I was expecting to sell off tomorrow, in which case I was going to close all my covered call positions. I ended up closing out today because we never know what tomorrow is going to bring. Plus, when you get up in these things, just take your money. That's what these are for. On Thursday, now this is the big day. On Thursday, we have the PPI data comes out, and that's the precursor for the CPI data. And that's the, what is it, producers index? And that's sort of like a forecast for the next CPI data. With all the commodity prices coming down, we would expect that the PPI data might be kind of favorable. Also on that day, we have Taiwan Semi reporting, we have Morgan Stanley reporting, and we have JP Morgan Chase reporting. And so I'm expecting this to be a really big bullish day on the market. So now with Taiwan Semi reporting on this day, I definitely don't want to have any covered calls in place on NVIDIA and AMD prior to these guys reporting, because I have a feeling they're going to, just like Samsung last week, is going to send the entire triple Qs and the semiconductors in particular up a bit through Friday, especially as they get squeezed by all of the bears that have their puts in and that sort of thing. Also, I plan on selling puts on Morgan Stanley and JP Morgan because, much like the semiconductors, the banks are really quite beaten down. I think we're going to find that they're doing just fine, that people aren't going to be defaulting on their loans, that they're making plenty of home loans, their trading activities probably fine because there's plenty of volatility out there. And they don't really have much more to drop. I mean, even if all three of these companies bomb, they don't have that much further to go down. They're just so beaten down. And so for that reason, I'll be selling puts on all three of them. As a matter of fact, in this example I'm going to show you here, I'm going to be selling a 1x2 strangle on Taiwan Semi, and I'm going to show you how that's done. So why am I so bullish on Taiwan Semis this week? Well, a lot of it has to do with last week Samsung reported a good quarter. Qualcomm reported a good quarter. And these things all seem to go together. South Korean tech giant allayed some of those fears, leading to a rally in chip stocks such as Taiwan Semi. Samsung had a good quarter. A lot of their chips are made at the foundry that is Taiwan Semi. The other thing that has me really bullish on them is they just reported on July 8th, Taiwan Semiconductors sees 19% revenue growth in June 2022. So they've already kind of pre-released these earnings, and they've shown to be good. Yet even though they pre-released these earnings and shown to be good, the stock is still, well, last week it was up a little bit, but over the past, say, month or so, the stock is still kind of tanking. And over the 6 months, it's down 40%. And then when you look at it fundamentally speaking, we have Taiwan Semis. It's rated as a B by Charles Schwab. It has a price to earnings ratio of 19, a forward PE of 13, and it trades under 1 PEG ratio, which is all very solid. It trades at a nice dividend with 2.93%, making it at least as good as a 10-year note. It has a 38% profit margin and 23% year-on-year growth expectations by these analysts. If you look down here at the balance sheet and you look at the income statement, you can see that it's a really nice grower every year. And it's not just the top line, it's also the bottom line is growing as well. This is a very, very, very strong company that's unfairly being beaten down because everybody hates tech right now. And so for that reason, I got my surfboard ready and I'm ready to go for a ride with these guys. So Taiwan Semi is currently trading at $79.11. And so the way that you calculate the standard deviation for this is just like this. I would say that I want to, let's say, trade a call on Taiwan Semi that expires July 15th. And we can get as close to the money as we can here. Let's go with an $80 strike here. And that gets $1.69. Each contract is 100 shares, so that's $169. If I do a put and I do that at the money, it's $249. So the way you calculate the standard deviation is you sell a call at the same strike you buy a call at the same strike that you buy a put. And that's called a straddle. And I have that illustrated right here. Here's the straddle of Taiwan Semi at $79.11. And I've already done all the math for us here. So it's implying a $4.18 move, either up or down. That would mean that the market is pricing in a 5.28% plus or minus the strike. So if you're within 5.28% of this number here, $79.11, you're expected to win 68% of the time. So that would mean that we would expect that Taiwan Semi, if you provided you were between $74.93 and $83.29, you should win 68% of the time. Remember, this is very fluid though. Tomorrow, Taiwan Semi could be an entirely different price. So today, this is at the end of business today, that would be your strike. So if you want to sell a covered call and they were reporting tomorrow, a nice safe spot might be like $85. That would give you about a maybe 75% chance to win. Now, the further you go out in time, the bigger this percentage is going to be. Let me show you what I mean by that. So let's say that instead of the closeout date of July 15th, let's do it instead August 12th. Well, now I'm going to get $405 for the put, and I'm going to get $337 for the call. Now, if you add that up and divide it by 79, you're going to get a percentage a whole lot bigger than 5. So time is worth something because time is volatility. And so now with that as a backdrop, let's go ahead and watch that video, just a really short video, and because I think it illustrates this point very, very well.
I wanted to go over a little bit about mastering the probability curve and market randomness. And the reason I want to cover this in depth in this video is because I do think it's one of the foundational elements to really understanding and really grasping the logic behind why we do what we do with options trading, right? It's not just whimsical. We're not going out here like a bunch of cowboys on a rodeo horse and kind of shooting from the hip and picking trades and making bets. It's got to be a very logical and systematic way of doing things. But applying that to the stock market is a little bit different. And some people don't have the insight or at least the vision to understand how this really translates to stocks. So what we do is we then take a look at a chart like this, right, where we kind of take this same graph and turn it sideways. And that's basically what we have when we look at really any stock chart is we have a normal distribution graph going out into the future. So as we go further and further out into the future, then the likelihood of the stock making a bigger and bigger move obviously increases because we move further and further out, it's got more time to make that movement, right? So that's where we actually get this distribution graph from. Now, we're going to use Apple as an example because it's really highly traded, very liquid. So now we have this probability cone that's basically set up for us on this chart, and I'm just cutting off a little bit to show you guys, but this probability chart now shows you within a 68% range where Apple might trade 68% of the time between now and all of these different expirations in the future. So remember that these dotted red lines on the charts are all expiration dates in the future. June expiration, July, August, September, etc. So it can vertically show you at what point in the future Apple may or may not trade within that range. Now it's pretty obvious that that range is going to continue to expand both on the top side and the bottom side as we get further and further out into the future because the stock has more time to move, right? Right now we're about 21 days till expiration in June, but the stock has more time to move if we traded something in July. So we want to use those figures versus the June figures. Now what this is actually showing you is that there's a 68% chance, because that's what we have the cone set up as right now, 68 probability level. There is a 68% chance that from Apple today, from where it's trading today at 644, that Apple trades within this range between now and June expiration. And that range is 595 on the lower side, so 595 down here, and 668 on the upper side. So again, a 68% chance that, or more or less a 70% chance that Apple trades between 668 and 595 between now and June expiration. Okay. Now, if we go out further and we actually trade July options, then you can see that within that same 68% confidence range, that we actually have numbers that are further out. So it's actually saying that between now and July, there's a 68% chance that Apple is going to be between 180 or 685 on the top side and 574 on the bottom side.
All right, so that was a video that I really, really liked, and I thought that it was neat the way he turned it on its side and kind of illustrated the point in that way. Let's go ahead and see what I plan on doing with Taiwan Semi for this week, and then we'll look at the portfolio and show you what I did today. So with Taiwan Semi, what I plan on doing is a 1x2 strangle. A straddle is where they both and buy a put and buy a call at the same exact strike price. A strangle would be right over here. This is where I sell a put and I'm selling a call, one standard deviation out of the money. That's what I'm going to do. And I'm going to sell two calls and I'm going to sell one put. And that's why it's a 1x2 strangle. If I was to buy a call here and buy a put there, this would be called an iron condor. And so these are just like little names for these trading strategies. Now I'm going to do it a little bit differently because I only have level 1 options. In order to do this without owning the underlying stock, you need to have level 3 options. I don't have a need for that because really I just don't have the time in my life to go ahead and be that kind of an options trader. So what I do is I'm going to go ahead and I've just bought the stock, and then after, maybe just the day before they report, I'm going to trade one standard deviation out. A common practice among traders might be to like buy a call and then have Taiwan Semi report, the stock goes up. Let's say they buy the call for $1 or $100. Well, then if Taiwan Semi goes up and then they can, let's say it goes up like $5, then they sell the call against this call that they bought. If they sell the call for $100, then one of two things can happen. They're either going to make $500 on their option that they bought, or this thing's going to finish, the call that they sold will finish worthless, and now they have a free call that they bought. And that would be a very common thing for a lot of traders to do. So they buy a call, wait for it to go up, sell a call, and now they've got a free option. I'm not doing that. I'll show you what I've done or what I'm going to do. Actually, I've already bought the stock. Yeah, so I'll show you what I've done, but I haven't sold the calls yet. And I actually sold the put too. All right, so here's my options activity for today. It looks like I made $246 today. Like I said, I went ahead and I bought back all the covered calls that I sold on Friday right before close. The reason why I did that was because I just like to take the money where I can get it. So with these options, it's not about just cutting losses and trying to save money that way. You've also got to profit. You've also got to make some money. And when I see these things, these opportunities arise, I take that opportunity. I also did buy a little bit of Taiwan Semi and sold today for a $49.95 profit, it looks like. And I did sell a put and buy that one back and made $12 there. So, I made $246 today, but I also set myself up for the future. So what I ended up doing was I bought 200 shares of Taiwan Semi at about $79, and maybe on average here about a $79.30 strike. And then I sold another put and I sold it for $56 with a strike of $75. So I did my one standard deviation out of the money. And then on Wednesday, because they report on Thursday morning, on Wednesday when I expect that they're going to go up, that's when I'm going to sell my covered call. And I'm also going to probably sell one put on JP Morgan and maybe one or two puts on Morgan Stanley. So this is going to be a busy week for me with options. Well, that's about all I got for today, you guys. Hope you guys got something out of this video. If you did, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.